So morning, my online viewers. It's a nice time we meet again for advanced financial reporting. So today I'm going to talk about associates and joint ventures. That is under group accounting, or we call it business combination. So now here, when you want to account for the associates or joint ventures, so you need to know what are joint ventures and what are associates. So remember that associates whereby the parent company has acquired, that is between the percentage of 20 to 49. So here you will find that the parent doesn't have control, but the parent have significant influence. So here is all about the parent having a significant influence on the other invested company. So where he has acquired a percentage of between 20 to 49. So then now, what are joint ventures? Joint ventures is whereby two parties or two entities agree to come together and invest somewhere. That is whereby now, for example, A coming together with B, and they agree to invest in company C 50%, 50%. So now, in order to understand what this topic concerns, that is accounting for associates or joint ventures, so you need to know that we account for the two invested companies. So the parent accounts for the two invested companies using the equity method. That is now International Accounting Standards 28, whereby initially you measure the associate or joint venture with the initial cost, you add post-acquisition profit, then you raise impairment loss. So you initially measure with initial cost, you add post-acquisition profit, that is the share post-acquisition profit, and you raise impairment loss. So now let us do a question of June 2012 in order to understand more what associates and joint ventures concern. So let us check on that question and you will be able to understand. So now this is the question. So now this is the question which was tested in June 2012. So this is the relevant question which was tested on June 2012, question 1. So the question reads, so we can display it on the other side. So the question reads, the following financial statements relate to H Limited and its investment companies. So I've said the financial statements relates to H Limited and its investment companies, S Limited, A Limited, and J Limited for the year ended 30th April 2012. So we have income statement for the year ended 30th April 2012. So here now, that is the income statement. So you don't have to read the transaction in the income statement because you know they contain of incomes and expenses. So let us move to the next statement. There you are told that there is a statement of financial position as at 30th April 2012. So you have the statement of financial position. So my main concern, even if you are in an exam situation, your main concern now, go and check under the additional information, because already you know that the income statement contains of incomes and expenses, and I've already said that statement of financial position contains of assets and liabilities. So our main concern now is the additional information. So the additional information there we can see number 1. So they are saying that additional information number 1, they are saying this. So they are saying that H Limited acquired the investment in other companies as follows. So H acquired company S, acquired A and J. So we can see here he acquired company S, A and J. So date of acquisition. So the date of acquisition is 1st May 2008, 1st May 2009, and 1st May 2010. Next thing I can see a shareholding 80%, 40%, 50%. So you can see that the H acquired S up to 80%. So 80% is a subsidiary. So the S Limited is a subsidiary company to H. Then A Limited is 40%. So I said between a shareholding of 20 to 49. So the other invested company is supposed to be called an associate. So now you can see that H acquired the investment in A Limited up to 40. So 40 rise between 20 and 49. So it means that is an associate. So this is an associate. Then the next thing we have J Limited. J Limited is 50%. So 50% I say that is a joint venture whereby now H may be agreed to with other investors to invest in company J. So H invested 50%. So we have other investors which we don't know who invested also in J Limited up to 50%. So cost of purchase, we have there 300, 200 to 50. We have revaluation reserve. Revaluation reserve, we have 20, 15, and 20. So these are the revaluation reserves as at the date of acquisition of the relevant investee companies. Then we have retained profit. Retained profit, we have 85, 150, and 120. We have H Limited also invested in half of the investment of, H Limited also invested in half of the 10% loan stock in S. So here now, if you can see, we have cost of purchase. Cost of purchase, we have 300, we have 200, and 250. So it is adding up to, that is 50, then this is 750, 750. So this is the cost of purchase. Sometimes we call it cost of investment. So here we have 750. So if you can see on the other side, under the income statement, that is under the statement of financial position, not income statement. So under the statement of financial position, we have investment. So the investment here is 850. Investment is 850. But on the other side, when we added, it was 750. So it means here there's a difference of 100. So the investment, total investment is 850. So 850 they invested in S, A, and J. That is, they invested in S, A, and J. So here, so we have 850. But now the real sense here, they were saying the balance on this side is 750. So it means here there's a difference of 100. So that's why this difference of 100, that's why on the additional information, the next thing they talked about is they say that H Limited also invested in a half of the 10% loan stock in S Limited. H Limited also invested in half of the 10% loan stock in S. So now they also invested, H also invested in the 10% loan stock. So half of the 10% loan stock. Let us check the loan stock in S. So the loan stock here, it's under the non-current liabilities. So non-current liabilities, you can see them on non-current asset, on non-current liabilities. So here we have the 10% loan stock. So the 10% loan stock in S is 200. So half of 200. So 200 times half. That is 100. That is 100. So that is the difference. That is the difference which they also invested. That is the difference which they also invested. So here we have already seen that the difference of 100 is from whereby they invested also in the 10% loan stock in S Limited. Yes, number 2, the fair value of the non-controlling interest. Fair value of non-controlling interest in S Limited was 75 million on 1st May 2008. So it means that when you have the fair value of a non-controlling interest, you are supposed to use the full method in computation of goodwill. So that one shows that we are supposed to use full method in the computation of goodwill. Sometimes the examiner can miss to give you the fair value of non-controlling interest as per note 2, and he will provide the market price of ordinary shares attributable to the subsidiary company. So also in that scenario, you are supposed to use the full method. So number 3, during the year ended 30th April 2012, H Limited sold goods to S Limited and A Limited as follows. So he sold goods to AS and A. So we have the selling price of 100 and we have the selling price of 50. So remember, he sold to S. S was a subsidiary. A is an associate. So here the profit margin on the goods sold is 30% and 20%. So percentage in stock at the year end, that is 50, and this is now not applicable. There is nothing which was remaining in the stock of A. So here we have to check the unrealized profit on stock, because now here, remember, H sold goods to S and A. So he sold goods to S and A. So S is a subsidiary, A is an associate. So out of the goods he sold to S at 100, including a profit margin of 30%. So at the end of the year, S has not sold all the goods. 50% were in the stock at the year end. So we have to check the profit which S has not realized out of the goods he bought from H. So we have to check for the unrealized profit, because we know that UPS is equals to unsold stock. You are supposed to multiply with profit margin. So right now here, the unsold stock at the end of the year, S limited, unsold stock is 50%. So 50% of 100, because now he received the goods at 100. So 100 times 50%, that is 50. Times the profit margin of the 30. That is 15. But now for A, remember that is an associate. Even we don't consider the intergroup sales between the parent and associate. We only consider the intergroup sales between the group. So group, I said that when I introduced this topic, group consists of the parent and or the subsidiaries, but not associates and joint ventures. So intergroup sales, you only consider between the parent and the subsidiary. So you don't consider associates and the joint venture. So even if they could have said that there is a percentage which was remaining, I could have not considered the intergroup sales of H and A. Number 4, on 1st May 2010, H Limited sold an item of plant. Remember, plant is a fixed asset for shillings 200 million, reporting a profit of 25% on the initial cost. So when they talk about the initial cost, they mean this is my markup. So 25% profit on the initial cost. So H sold an item of a plant to S at 200, reporting, that is H reported or recognized 25 profit on the initial cost on markup of the plant. So the group charges depreciation at 20% per annum on cost on plant. So here it means that I will be checking for the unrealized profit on fixed asset and depreciation overcharge. Because now, when H sold an item of plant which is fixed asset to S at 200, remember already he recognized a profit of 25%. Here, S, which received the plant and paid everything, that is 200 including the profit, has not resold this asset in order to realize the profit he already paid to H. So that's why now we have to check for the unrealized profit in S, which he never realized it. Then we will adjust accordingly. Under the property, plant and equipment. Then they say that the group charges depreciation. So remember, group is all about the parent and subsidiary. So both of the two companies charge the depreciation. And remember, they are group members. So that is double depreciation. So we have to check for the overcharge. The depreciation overcharge, then I would adjust accordingly. When we will be doing the statement, I will show you. So number 5, all the goodwills of the 3 companies in which H Limited has invested are estimated to be impaired by 25% in the year ended 30th April 2012. So this is all about impairment. No impairment losses have been reported in the past. That is okay. That is direct. So that once we have computed goodwill, I will impair the relevant goodwill. So remember, goodwill is an uncurrent asset, while impairment is an expense to be recorded at the income statement. Included in the trade and other receivables and the trade and other payables are the following outstanding balances. So due from S to H. So now included in trade and other receivables. So here they mean that there was something which was owings between the companies. So we said that if we have intergroup owings, or we call them intergroup balances, so if there is anything concerning intergroup owings, at the end of the financial year, we are supposed to forget those amounts. We are supposed to cancel them. So if, for example, now here, I know that H is the parent, H is the subsidiary. That is my scenario I will consider most. I will consider that one between H and S, because now it's between the parent and subsidiary. Like now here they say due from S to H. That is okay. They are group members. Due from A is an associate. I don't consider that. Then due from H to J is a joint venture. This is a story. We don't consider that. So my consideration would be most under H and S. So there is something due from S to H. So here S is supposed to be H 50. is supposed to pay the other company fee 50. So that is owings. So this amount we are supposed to cancel out. But before I cancel this amount, relevant in the accounts, in the books of accounts, I can read the next information. They say that because this is under additional information number 6, they said in the books of S, the amount due to H remitted was shown at 40. But here we saw that they are saying 50. But now S, the books of S is showing for 40. So there's a difference of 10. There's a difference of 10. There's a difference of 10. So they said that was shown as 40. So in the books of S, the amounts due to H was shown at 40 million. Because S Limited had sent a check for shillings 10 million, but H had not recorded the check. So it means that the amount of 10 is on transit. So now for up to this point, the correct owings, the amount due to H is 40. Because already H has already written a check and he has cleared from the account receivables, from his account receivables. So the owings I know up to this point is 40. So in my case, I will credit 40 on the receivables account, and also I will credit 10. So it's like subtracting 40 and 10. Then now when I go to the payables, I will debit the 40. Remember now, by crediting 40 under receivables and I debit 40 under payables, I have cancelled out the owings between S and H. Now the 10 will be subtracted, that is credited under receivables because it has already been paid. Then it will be received by H under the cash or bank balance account. So I will add it under cash or bank. That's all. That's how you are supposed to make the adjustments of the intercompany owings under the trade and other receivables account and the trade and other payables account. So you forgo the amount. You forgo the amount of the owings at the end of the financial year. So all the balances were in agreement. It's okay. Number 7, the group uses full goodwill method. Already we know it's full goodwill method because they have given us the fair value of NCI. So it's not a must they could have been provided note 7 because already they have provided note 2 where they say that the fair value of non-controlling interest in S was 75 million on 1st May 2008. So it's not a must they provide note 7 because now already we know. So now number 8, all dividends and interest had been paid by the end of the year. It's okay. So they need the income statement and they need the statement of financial position. So once you are able to interpret the additional information in the shortest time period, now here we can go to the computation because now the computation is what will be marked. So you have to show what you think on the paper. So now here, let me start the presentation of this relevant statement. So now here, the first thing I will write the relevant question is on June 2012. So it's on June 2012. So that is June 2012. June 2012. Now here, you are supposed to start from the structure. Start with the structure and the shareholding. Structure and the shareholding. Just draw a structure and the shareholding showing how the parent acquired the investee companies. Remember H, according to additional information number 1, H acquired 3 investee companies. He acquired S, he acquired A, and he acquired J. So S Limited, A Limited, and J Limited. So he acquired S up to which percentage? 80%. He acquired A up to 40%. Then he acquired J up to 50%. Up to 50%. So now here, the next thing is to check the dates. Because now if the subsidiary is acquired during the year, we have to apportion accordingly from the date of acquisition to the end of the year. That is, we have to consider under income statement only the period the subsidiary was existing. But under the statement of financial position, even if the subsidiary is acquired only 1 month to the end of the present financial year, you will just record the whole figures. So now here, our financial statement ends on 30th April 2012. You can see under the requirement, they are saying, consolidated income statement for the year ended 30th April 2012. So it starts on 1st May. It starts on 1st May 2011. When did they acquire S? Additional information number 1 says H acquired the investment in other companies as follows. So he acquired S on 1st May 2008. So it means in the current year now, from 2008, in the current year. For example, in your scenario, if you acquire a company from, let's say, 2010, in the year 2019, when you are preparing your books, it means the company you invested on, it's existing in the current year fully for 12 months. So here, S was acquired on 1st May 2008. We are preparing the books for 2011, that is 1st May 2011 to 30th April 2012. So it means that S is a full year subsidiary. What about A? A was acquired on 1st May 2009. The same thing in 2011-2012, it is existing for full year. Then J was acquired 1st May 2010. So also it means that since it was not acquired in the present financial year, from previous it was there. So in the current year, when I'm preparing my books, it's there for the full financial year. So now I will go direct to the first requirement, which is the consolidated income statement. So I will say H limited, consolidated. I will say H limited, consolidated income statement, consolidated income statement for the year, consolidated income statement for the year ended 30th April 2012. Now here you have to be more fit and you have to increase your speed because every question needs around 40 minutes. So now we start from revenue. As per the income statement, you are given revenue the first thing. So I will take 1200, I will add 600, that is the subsidiary. I will subtract intergroup sales. So intergroup sales, they say that additional information number 3. During the year ended 30th April, H sold to S and A. So remember, he sold to S Limited and A Limited. So intergroup sales, we consider only between the parent, that is S, that is H, sorry. Parent, that is H, and subsidiary S. A is an associate. We don't consider transactions between associates and parent because associates are non-group members. So here I will consider the intergroup sales of H and S, which is 100, and additional information number 3, which is 100. So there is no another intergroup sales because now even if this intergroup sales of plant, according to additional information number 4, it was done on 1st May 2010. So they are saying that on 1st May 2010, H sold S an item of plant. So remember, we are considering intergroup sales in the current year, 1st May 2011, 30th April 2012. And this additional information number 4, the plant was sold 2010, outside, that is, outside the current financial year. So we don't consider that. So it means we are done with the consolidation of revenue. So I move to the next thing, that is the cost of sales. So let me consolidate cost of sales. So cost of sales, you need to be more keen what I will be doing because it's more comprehensive. But things which are comprehensive is what you are supposed to understand more. So we say 650 plus 250 minus 100, which is intergroup sales, the same intergroup sales. I'm supposed to add UPS. So we can do a short working here. So yeah, I can say workings. So I can short working. So what about UPS? So UPS I said is equals to unsold stock times profit margin times profit margin times the profit margin. So there was intergroup sales under note 3, the one for 100. So out of that, the one which is unsold is percentage in stock at the year end is 50%. So I would say 50% is a half times the 100. 100 is the intergroup sales times margin. Margin is 30%. That is 30 over 100. So it's very simple. Then you can pick your calc and say that is 3. That is 100. 100 times 30. That is around. I can say direct 3,000. That is 3,000 divided by 200. So this is 15. So that is 15. So here I will add 50. The 15. Then here I'm supposed to check if there is a UPS on opening stock. So it means, opening, I mean, if there was the same transaction right now which occurred in additional information number 3, but they could have said during the year ended, they could have said that during the year ended 30th April 2011. So remember that that one could be for the previous financial year. So that now we do the same thing, but now it could be for the previous year, which would be the opening for the current year. So that one you subtract. So if they could have just changed the dates in note 3, they could have said that during the year ended 30th April 2011. So I could have said that it's an opening. So the same thing, but it's an opening. So you subtract the UPS on opening. Then the next thing I'm supposed here to add is depreciation. I'm supposed to add the depreciation undercharge. So depreciation undercharge is due to revaluation. But here we don't have revaluation, because always you know that the revaluation is the difference between the carrying amount and the market value. We don't have something like that in this question. So the next thing I'm supposed to check is depreciation overcharge. So depreciation overcharge is there because there's a sale of fixed asset. So depreciation overcharge. Because they sale of fixed asset, I have to check that one. So they said that here